Hello, everybody. My name is Kathleen. I am joined by three other infinite banking practitioners, Mike, Will, and Scott. And we are here to talk today about strategic uses of cash values. As you may or may not know, in an infinite banking policy, one of the best features is something that is akin to a big line of credit, which is called cash value. And you can borrow access up to 90% of cash values. So we're here today to talk about ideas that we see clients, what they like about it and what they are using their cash values for. I will start with Mike. What's your favorite thing to talk to clients about with cash values?
Well, I think one of my most favorite things, and I'm sure Will and Scott can attest to this, is that it's only limited by your imagination. One of Nelson's great things is the imagination required in order to implement and execute an infinite banking concept in your life is only limited by your imagination to be able to use those policy values in whatever way you see fit. And one of the benefits of doing that is that you can really start multiplying the key strategies in order for you to multiply your wealth and multiply not only your tax efficiency, but not only the opportunity costs that we give away constantly to other people. When, for example, if Scott's going to sell me his motorbike, because he's got a Harley that I want maybe or something like that, and if I give him that $35,000, well, guess what? He's now in possession of the money. I'm in possession of the bike. But what infinite banking allows us to do is rethink our thinking. And now I actually haven't given away my money, but I've leveraged against its value so that I don't lose the future returns that are growing tax-free in my possession, while I still have the ability to enjoy the use and benefit of the things that I buy with that money. So
I like that. My husband wants to probably buy a boat with the cash values, whereas I want to buy real estate, lend and borrow real estate.
Well, I mean, if you maybe Airbnb the boat or something, you can create an ongoing income out of that, Kathleen. Maybe.
Sure, I wonder what the insurance would be on that. But Will, you look like you had something to add?
Well, yeah, I totally get what Mike is talking about. And this is the message that we really want to convey here is, like our friend Wayne Dirksen, who is part of IBCanada Group, a very vital part of the board, actually. He always reminds people that we must be able to treat our cash as capital, like the wealthy have done for generations. And once we understand capital and what it can do for us, we'll never want to part with it. We've been taught to pay cash for things and drain the account. Like Scott's been saying to all of us, that's like cutting down the apple tree to pick the apples. We have to plant the tree again. And this is the message that infinite banking really wants to convey in a very factual way, is that the wealthy have known this for generations, that, you treat your cash as capital. And if I'm never to part with my capital, then I have to be very mindful. First of all, where I store it, and secondly, how I deploy it, how I'm going to use that capital. If I want to buy that Harley, am I going to drain the account? Am I going to use, somebody else's money, or am I going to use my own money and let it continue to compound while I'm, buying that Harley? And so the idea of letting our money compound and borrowing against it. And we know this, that when your money is compounding, compound interest, as Einstein talked about, the eighth wonder of the world, it absolutely, the growth will crush the cost of the interest. The cost of the interest to borrow that money and pay it back is minimal compared to the cost of what it will compound to.
So it's not just your cash that's the asset, but it's your access to capital. Okay, got it.
Very well said. Yeah.
Yeah.
And while you have access to that capital, as Will and Mike had talked about, you're not interrupting its compounding growth. So we have to understand that whether we pay cash for something or we put it on credit. We finance everything we buy. Credit, we're paying somebody else interest only because they capitalized their system in the first place to lend their money to us. If we pay cash, great, we were savers. But as soon as we saved out that money, we've now done a physical transaction, transferring that money away from us. And it's not just that dollar amount for, say, a $5,000 vacation or a $35,000 Harley. Like, once again, it looks like I'm going to have to buy a Harley just so I can sell it. It's the fact that that money is no longer in your system. So therefore, it has no economic value added attachment to you. You've given up the ability for that money to consistently earn money for you for the rest of your life. And this is one of the biggest problems with financial planning, is it has us always transferring away that money. And if we were able to recapture even the smallest amount of every transaction, that can lead up to tens, if not hundreds, to millions of dollars that you're going to have for your retirement. But right now, you just don't know that you're essentially letting that money go right down the drain.
I like everything I'm hearing. I'm hearing a lot of high level stuff. When I was preparing myself about what I would say on using cash values, I was thinking more specific about things. Like, for instance, in retirement, a typical retiree would want to have some money in GICs or safe money. But GICs, like right now, like a 10-year GIC is earning, let's say, 3%, but it's also taxable. So I like the fact that I get to build up cash values. My clients get to build up cash values in retirement. They have a significant portion of safe money, and then they don't have to get low interest paying GICs or fixed income. They can use a different proportion of their money more aggressively, because that will be their safe pool of money. Any other specific things, maybe, Will?
Well, actually, if I could just jump in there real quick, I think it's interesting that your money is at work all the time. Now, who benefits from that? If you've got money sitting in a GIC, that money is going to benefit the banking institutions who are going to lend it out at a rate of interest and create income streams out of that money. If I were to buy one of Scott's multiple Harleys sitting in his garage, now he's going to start a Harley Davidson dealership, by the way. And if I give my money to a dealership or to Scott or to whoever I'm buying an asset from, whether that's a motorbike or a boat or whatever it is, the compounding returns that Will was talking about are always in effect and always at work, but not always at work for me, and not always in effect for me. When I no longer own that money, I've given away that opportunity to earn a return on that money. Secondly, when I have money sitting in a GIC, it is no longer my money if I have it on deposit with the bank. And this was clarified back in the really mid 1800s by Lord Cottingham, who in the British high courts confirmed that banks, when you deposit into a bank, it is no longer your money. You no longer have the title rights to that money.
Of your money.
Correct. So you are giving up not only the use and control of your money, but if they lose it, it's not your problem. It's not their problem. It's your problem, rather. So I just prefer control over my assets. I prefer control over my money, and I prefer not giving away the opportunity of making something on my money forever. So that's why when we think about GICs, it's actually a lending relationship. You are the lender to the bank. And so do people really realize that? Do people really recognize that? Or do you retain control over your money rather than them borrowing it for their purpose?
And Mike, I want to add to that too, and what the rest of you have said in leading into is that IBC policies, infinite banking concept policies, they're considered property. And with property, we have property rights. And you don't have that when you're putting money into a bank, because you're a creditor instead to the bank. And so, we have fundamental freedoms with property, and it can't be frozen or seized.
Scott, could you expand on using cash values for opportunity money versus not?
Well, I've spoken to the group a number of times, and this kind of goes against the whole principle of infinite banking, but it also expands on the principle of, since you are the banker, you get to control and determine what to do with not only your capital, but the ability to utilize that either privately through your policy, or you access somebody else's capital, say the bank. So back in February, we purchased a Honda Pilot. I could have easily paid cash for that vehicle with a policy loan. But instead, I weighed the factor, since I was in control of the process, that I decided to actually take the bank's money. Now, the reason for that was that that vehicle is going to depreciate at exactly the same rate, regardless of how I financed it. And when I'm financing it from a financial institution, one either being the bank or two, the insurance company. So there's still going to be a cost for the transaction. But either way, I still get to keep my money. But if I had transferred the money out of my policy and put it into the vehicle, I would have a vehicle that's fabulous, but a vehicle that's an asset that is depreciating. So I instead decided to keep liquidity using control of my cash value to take advantage of an opportunity where I have capital appreciation opportunities. So that could be, I could put money into a second mortgage, I could finance a flip, or as what I've been waiting for is the stock market to sell off. And now I can use my capital to buy an asset that's going up while I still have the car.
So when you purchased the car, bank financing was available to you as a policy loan. So you went with the bank because it was probably an attractive rate. But
it was actually higher.
Leaving that door open, because it will be harder for you, for example, to maybe get a loan for a stock portfolio. So it was easier for cars, so you left the opportunity cost.
Right, because honestly, what could I do? Pledge the car, get a loan for a car because I got it paid off. I essentially would have transferred my liquid cash into an illiquid asset.
So truly, you thought about it strategically and decided that was it, and you left the cash value for opportunities which have come along.
Right. And I'm not in debt because from a balance sheet, I have a liability and I still have an asset.
Right.
In fact, I have two assets. I have the car and I have my cash value, and I have one liability, which is the bank loan. So at any point, I could pay off that liability if I want to.
Can I jump in here for a second?
Yeah.
When that opportunity has happened just 2 years ago when the market crashed, when COVID came in.
Exactly.
And I had clients and we all had clients that had money in their accounts. And some of these savvy clients that we have, maybe have their own Quest Trade account or whatever, and they don't want to pay the mutual fund fees. So they started up their own Quest Trade account. When the market fell off a cliff like it did in March 2020, what did the wise people do? Well, one of them took a policy loan for over $90,000 and bought into some very nice companies. Those companies went up over 120%. So they doubled their money, and the cost of borrowing for that 1 year was just less than $4,000, for that $90,000.
What I hear about this too is that when they didn't need the money, as you mentioned, it was still compounding and growing, and you're not missing out. But then when you want the money, versus people that don't have infinite banking policies might just have that money sitting in a bank account earning nothing until the opportunity comes along. And that's what they've been taught. We've been taught to do that. And so IBC has a different message, much more efficient message for everybody. Mike, how does a infinite banking policy and the cash values help with fighting inflation? Everyone's talking about inflation now. It's just crazy.
Yeah, so that's a very interesting and deep topic.
Mike's favorite.
Yeah, it's one of my favorites. I'm fairly vocal about inflation.
Your Instagram fires up twice a day.
Yeah. So let's be very clear on defining inflation. Inflation is not rising prices. Rising prices is a symptom of inflation.
Right.
Okay. Inflation is, as Milton Friedman said, inflation is always necessarily a monetary problem. So when governments increase the quantity or stock of money, what that leads to is a devaluation of that money. And we think it's rising prices, but if we properly put this into perspective, it's actually that those dollars have less buying power today. So therefore it takes more buying power to buy the same thing. That Harley that Scott bought, well, 2 years ago, it might have been 35. It might have taken $35,000 to purchase that, but now it takes 60,000 because the purchasing power of the dollars and flowing around in existence is less. So therefore the Harley itself isn't worth more. The price isn't up. The dollars are actually worth less. So to answer your question now more completely, having an understanding of what inflation really is, now we understand that there are certain asset classes that rise up in early inflation and certain asset classes that rise up in late inflation. So as in the beginning parts of inflation, we saw in March 2020, the government dump billions of new money into the economy. And what happened? The stock market went up and the housing market went up. Okay, again, it's just the devaluation of those dollars.
Right.
So Richard Cantillon, who was an economist back in France in the 1700s, he knew that as the US was printing literally back in those days, thousands of dollars of these continentals, what happened is that land values went up. Land values always go up first. If I have extra dollars, I've got to do something with those extra dollars in my hand. And before the commodity prices go up, well, I'm going to invest. So that's why we saw the real estate market go up. That's why we saw the stock market go up. Cantillon did the same thing. He bought half of Louisiana with the newly printed money, and he became one of the wealthiest people in the world at that time. So when we see new dollars going into a market, we first see that going into specific asset classes. And if I have money available to me at my disposal to use at my discretion, I'm going to get into exactly what Will's clients did. And they obviously did very well with having the ability to leverage against their capital. I think Nelson Nash, the originator of the IBC concept and the author of many great books, including Becoming Your Own Banker, there's Will's copyright there, was that opportunities come to those with money, right? The golden rule is he who has the gold makes the rules. So if you've got the gold, you're going to make rules and you're going to be able to capitalize on opportunities with that. Now, in the later part of inflation, as interest rates start to go up, well, the returns that we're earning inside the insurance policy are going to slowly start to creep up comparatively to bank deposits because they're not paying anything anyway. But as interest rates go up, the vast majority of the asset classes inside an insurance contract are loans. So as loans get repriced, loans go up because interest rates are going up. My returns are also going to go up. So from an IBC perspective, the cash is available. The rates are going to be much more nimble and responsive to increased rates. And I'm going to protect my capital from radically inflating money supply.
Can I add one extra thing to that, Mike?
Yeah.
At the early stage of inflation, because there is a massive injection of fake money into the system, all that money pushes down interest rates. Borrowing becomes easy. We have capital. Lending is available to almost anybody with a Beacon score over 500. All that money is now chasing a finite amount of supply or product. And then you start to get the inflation in those prices. But then, as you said at the end, it trickles down to higher interest rates because now the money is being pulled back out of the system, which is quantitative tightening. The deposit of money into it is quantitative easing. And we all heard that back in 2008, 2009, which essentially has gone on for 14 years. When that plays itself through the system and the Federal Reserve and the central banks start to pull the money back out of the system, we have tightening. Now there's less money and inflation now starts to run rampant.
Love all this inflation talk. It's so relevant, and people don't understand how they're losing so much money unknowingly and unnecessarily. But back to cash values. I mean, one of the ways that I love cash values is that it beats inflation, because your cash value is a pool of money, but every time you pay a premium, if your premium is, let's say, $10,000 a year, it's technically less and less because of inflation, but it purchases more and more cash value every year. And as you approach your life expectancy, your cash values start to approach and equal your death benefit eventually. And so in that way, in cash values and whole life insurance and infinite banking is an asset class that can keep up with inflation. It's inflation friendly. Anyway.
Well said.
How does one use cash values to pay less tax over one's lifetime?
So if we jump right to retirement, then over the decades, we have been utilizing our system to create a large capital pool, which is our cash value. Now, the ability that we have at that point is to utilize that cash value as collateral for a third-party loan. So this would be just like the same concept of reverse mortgage. You have the value of the house as an asset, and now you get to extract money from that value. Now, the great thing is when you borrow money, any loan that you have is a completely tax-free transaction. Loans are never taxable. So we now have this large pool of money that's going to go up every single day and increase in value, as will the death benefit. And we have the ability to borrow against it without interrupting that growth. So your cash and your death benefit are going to be growing while you're still receiving income from your infinite banking policy via a third-party loan. Now, contrast that to the traditional wisdom of financial planning by having your money in assets, that the only way to get access to that asset is to literally sell some of it off. A RIF, you have to take out a certain dollar amount. Well, if you take out a certain dollar amount, now you have less to grow forward. And that becomes essentially a self-cannibalizing issue, unless you're taking on additional risk to try to grow that portfolio at a rate that's greater than your withdrawal. The whole system that we're led to believe we should be doing doesn't actually make fundamental sense when you understand that you are going to be eating into that capital. And when people start to see that capital pool decline, they go into a behavioral finance mentality called scarcity.
Yeah.
And that is, oh my God, I can't afford for this portfolio to go down. I want it to tread water. I need that $2 million to stay there forever. So now I'm only going to take out, 2 or 3% out of it to ensure that it survives. And the question has to be asked, you worked 45 years to essentially live the rest of your life in a scarcity mindset because you're afraid of what the market could do, what taxes are going to do? That makes no sense whatsoever.
And Kathleen, I wanted to add this too. With registered plans, that's the whole point. People think that they're getting, tax breaks with the RRSPs and whatnot. And, the idea is, okay, you can defer the tax or postpone the tax for the time being. But then when the time comes to go to take it out, now you're paying tax on all of it, all the money, all the growth that you worked hard for and put in for. And now a good chunk of that belongs to our silent partner, CRA. And then the other concept about RSPs that we as our group here have discussed many times is then we go and we reach age 71, we're forced to take the money out at the highest point when if it was just earning interest, it'd be earning more interest than any other year prior to. And now we're cutting down the tree, as we've talked about before, and we're decreasing that quantity, and it's no longer going to grow as much. And whereas what Scott was saying there earlier is if we could use a third party, there's a name for it. It's called an insured retirement plan, an IRP, recognized across the country. And that's the highest point at, let's say you're 70 years old and you've been putting money into these policies for 20, 30, 40 years maybe. And now you've got tremendous cash values, maybe 7 figures of cash value that's guaranteed to grow. Even if there's no dividend ever declared, it's going to grow, never go backwards. And so what do? Do we withdraw that? No, that's counterproductive. We could turn that into collateral, and is paying an interest rate of say 5, 6, even 7 or 8% to a third party lender. Is that cheaper than, let's say, 30% to the government or 40%?
Borrow against the policy, which is not taxable as income, just like if you refinance,
totally tax free.
Income
Yes,
taxable instead of collapsing.
Yeah.
One thing I want to add to that, which I know a lot of people are probably yelling at the screen right now, that we didn't address, and my apologies for that. But when you're doing the insured retirement plan, you're using your policy as collateral for a loan. There are no required payments.
Right.
The income that you receive from that, 1, is tax-free, and 2, there is no payment that is taking money away from that income to service the debt. The debt is what's called capitalized, so interest is added onto itself all the way through. You might be saying, okay, great, I have a larger liability because I'm not paying any money back on the interest or the principal. But at the same time, you never interrupted the growth of that 7-figure cash value. So it's compounding on the 7 figures.
And the outstanding loan will be paid off at death.
Exactly.
So,
And
Mike,
the leftover goes to the family.
Yeah. Mike, in your practice, do you use the cash values to help reduce pressure on other assets in retirement, or is that a discussion you have, or how does that work?
Yeah, absolutely. A lot of my clients are business owners, so they do a lot of these kinds of policies, and they structure them using corporate dollars owned by corporations and paid by corporations. The insured retirement plan, you can make it fly really beautifully by adding one letter in front of it called a C, which is a corporate insured retirement plan. and if you understand the theory of integration with the Income Tax Act, what is tax-free personally is tax-free corporately. What is taxable corporately should be also taxable personally. So I like planning in terms of not tax deferred or tax-free. I like using the word tax exempt because it's an exempt insurance contract as defined by the Income Tax Act. It defines these capital values inside an insurance contract as being exempt, both on the capital that grows in there and the return that you have while it remains part of the insurance contract. It's all tax exempt and collateralizable, if that's even a word. I just made it up.
It is now.
Put it on Twitter.
Yeah. If you see it on Twitter twice, that means it's got to be in Webster's dictionary somewhere. Anyway, what I love is the ability for, especially in a corporate scenario, corporations need liquidity. Corporations need access to capital. And so why not have your capital sit in a tax exempt environment? Yeah. But it's always available for you. And whether that's in a personal scenario or corporate scenario, it doesn't really matter. What matters is that you're giving yourself the opportunity for success. If you do, I'll come back to what Nelson said. If you don't have capital that's growing for you, the opportunities will pass by you. You just won't have the opportunity for that. So, in my opinion, I think it's always a good idea. And I think Kathleen, you and I have talked about this before, this particular issue, is that most Canadians think that having an insurance contract is only really applicable for the wealthy. And what most Canadians miss is that this opportunity is available for any Canadian. And sometimes you're not going to be able to get the 7-figure cash flow because you just don't have that kind of capacity. But even if you're doing something small, it's still going to be better than doing nothing at all. And using infinite banking is the most efficient plan, most efficient tax exempt plan in Canada at any income level.
All day long, I teach clients how to use these infinite banking policies and the cash values for retirement versus an RSP comparison. And they're just not used to seeing it. But when you run the numbers, they see that the tax bomb that RSPs will have, and that this can be tax-free income if structured properly. And we should all be using the tax laws to the maximum of our ability to pay the least amount of tax we can.
It's like, hey, what's the best way to travel from Vancouver to Toronto? And what road do I need to if I'm going to go to Scott's house in Ontario, and if I'm going to buy that Harley, well, I've got to get to Toronto first. Well, what's my most efficient way of travel?
Again,
well, Highway 1 is the best vehicle that I can use my vehicle on, or I can think differently, and I can say, well, the fastest way to get to Ontario is to drive to the airport. And I've got to choose a different vehicle in order for me to create better efficiency in my travel. Same thing with an insurance contract. If I'm not using an insurance contract, I'm using a bicycle to get across Canada, or I might be using a really fast car. What's your favorite car? It doesn't matter what it is. You're still going to get beat by a jet.
Yeah.
And Mike brought up an interesting point where he's talking about, the unfortunate aspect of insurance and how people think of it for the wealthy. The biggest issue is that we've been taught to think of life insurance as purely a death benefit only. And infinite banking allows it to be a living benefit. You get to use the money that you've put into it while you're alive without interrupting its growth. So you're still planning for the future, but living in the present.
Yep.
That's the big point. So don't think of this as a death benefit. You're getting all the benefits of all the money you put into it, plus a 3-4 to 1 ratio on top of those deposits. We got to look at it as a living benefit like the wealthy do.
And I wanted to add to that too. Good point, Scott and Mike, because most of the insurance out there, life insurance, is term insurance. And term insurance, by its name, terminates. And it terminates usually 99% of the time before the person whose life is insured terminates. And so that means it's very productive. It's a cash rich pipeline for insurance companies, knowing that, hey, you buy 20-year term insurance, in 20 years it's over with. You're not likely to die in the next 20 years. That's why they do all the underwriting that they do. Whereas we have permanent dividend paying whole life. I love that. And we're participating in the profits of the participating fund. And someday we're not going to outlive, that life insurance policy. And that's how many of the wealthy, the dynasties created dynasties, is through permanent dividend paying whole life. Mike just said earlier, it's not just for wealthy people, but we've read stories where that's how some dynasties were created, because of permanent dividend paying whole life, which will always pay out much more than you've ever put in.
I mean, I guess if anybody is contributing to an RSP, they could also be contributing to this type of finance vehicle. Right?
They could. And I think to your point, Kathleen, about when you actually run the numbers and show the benefits during retirement, you also have to realize that you're throwing your money in tax jail. If you ever had an emergency, if you ever had something that came up and you're like, oh no, I've got to use my RSP.
Which always happens. I mean, life happens.
Always happens.
In 10, 20 years, you're going to need it for something.
One of two things is going to happen. You're going to have a health challenge, which is maybe why you should take a look at living benefits policy coverage, but that's a whole nother topic. But the number one reason why people go dip into their RSPs prior to retirement is because they have some sort of health challenge where they need access to that money. I'm just not willing to throw my money into a place which is going to attract a punitive tax rate if I needed it in the event of an emergency. The last thing I want to do is face a higher tax bill because of poor planning.
And I don't even think it's just health issues. I've seen my clients, like, they've needed a new roof, they've needed a new furnace, and they've had to dip in, and they can't put that money back into the RSP. You can't just say, okay, I borrowed it, let me put it back. Whereas in an infinite banking policy, they can.
Correct.
I remember in the past, and I think almost all of us would be, in the same situation, being, coming across dealing with our clients on the asset side. And you're being paid as an advisor for assets under administration. You get a phone call from a client, oh, I need to pull $40,000 out of my RSP.
Yep.
And I remember always stating this to them, going, why would you do that and face a 40% tax when you could just borrow money at the bank for 9? Right? And that seemed like perfect logical sense. Why would I pay 40 when I could get it for 9? But the problem is, if I borrow the money from the bank at 9, are my investments even earning 9? Right? So it's almost like, why even have yourself in that position of having to choose and be locked up, being penalized either way, when if you could just understand the benefit of keeping your cash liquid, having complete control over it, and having access to it without interrupting it, you'd be in a lot better position. But we know that, sorry?
What's the best analogy for clients to explain how this might work?
Who wants to grab that one first?
In terms of having your cake and eating it too?
I mean, sorry, I'll just say what I'm thinking. To me, it's like a house line of credit.
Please do.
So
Yeah.
I'll let someone else answer it though.
Yeah.
I'll
No,
repeat the question. Okay.
you're absolutely right. It's like you're treating your real estate in terms of accumulation. Why aren't you treating your capital in the same way?
So Will, what kind of analogy would you use to simplify this for clients? Cash value.
Okay. I've moved from, let's say, a middle-class mindset to a wealthy mindset, because now instead of draining my bank account to make a purchase, I'm thinking, how can I make this purchase and get all my money back? And infinite banking is the only way that I know of. And it's simple. It's not complicated. And Tony Robbins wrote a book back a few years ago, and it was called Master Your Money. I can't remember what it's called. Anyway, it was a audio program as well. And I heard him say this, that, you have to educate yourself. This is the day and age where you're not going to sit in front of a banker or some financial guy or traditional financial mutual fund guy and say, this is what he's telling you what you need. You have to listen to these videos like this one that you're recording now, Kathleen, and then, maybe get the audio version of Becoming Your Own Banker. I send that the books to my clients all the time, and they educate themselves. They have to know the rules. If they don't know the rules, they're not going to win this financial game. And we've got financial behemoths out there making us think like we're winning, when in fact they're winning and the government's winning, when we could be doing much more with our education.
I think we've covered a lot today. I think we've covered how you can use cash values now in your wealth building years for opportunities, for real estate, to expand businesses. And we've covered also how you can use it in retirement to relieve pressure on your other assets as an alternative for RSPs, to collateralize it as an alternative to safe money like GICs in retirement. Is there anything else that anybody wants to expand on or mention?
What about you, Kathleen? You've said some great things in the past. Any way that thing that you would like to add that we didn't?
I think if I was to add anything, in terms of explaining it really simply, to me, it's like a house that continues to go up over time with a guaranteed line of credit that also goes up over time. And you have always access to that line of credit, and you can withdraw that line of credit as tax-free income. And just like your principal residence is tax-free, these policies, if structured properly, can also be tax-free. So it can be used as an alternative to RSPs. And we've used our cash values to buy 3 investment properties as an example. So
On that, I always make sure clients understand, because infinite banking really is a mirror image to real estate and equity lines of credits, like in the same access to getting access to an asset without interrupting its compounding. But I want people to realize where the safety and security is with infinite banking versus real estate.
yeah.
If I took my deed to the bank and I had $1 million house with no mortgage whatsoever, completely paid off, $1 million worth of equity, and I took my insurance policy with $1 million worth of cash value, both of them are identical assets in value, and I asked the bank to give me a loan and tell me what they would give me as a loan on each of them. My infinite banking policy, my insurance policy, they're going to give me a loan for 100% of the value, because it cannot go down in value. It can only go up. By the time I finish signing off all those documents, it's already appreciated in value. So the bank knows that that is an asset that has zero risk to its growth. On the flip side, if I go try to get a maximum loan from the bank, they're going to give me 80% and that's it. So if real estate is so safe, why is the bank not willing to give you 100% access to that capital? Real estate's still good. It just shows you that if you want to put your money in a safe vehicle, the insurance is the place to do it.
Scott, I remember hearing you say one time about the cash values being a safe store of wealth, but accessing them for more aggressive strategies eliminates that. Could you expand on that, or can you encapsulate that?
Well, because you control the banking function, you control the capital, you can choose what you want to do and what level of speculation you want to apply that capital towards. Now, because I've borrowed against the asset to go buy a speculative investment, if that speculative investment doesn't do what I think it's going to do for a 3, 6, 12, 24-month period, like I'm right with the investment, I'm just not right with the timing. Well, my capital has just been growing because I never interrupted it. I just borrowed against it. So while my capital is growing, and let's say that speculative investment has gone down in value, I have reduced my loss because my pool of capital is still there, growing an asset on the one side, while that loss on the investment is there until it suddenly starts going back up.
Right.
So that gives you that comfort, knowing that you can reduce your risk because your capital is still 100% intact and appreciating in value. And it allows you the opportunity to ride out an investment for a longer period of time because it doesn't look that bad on paper when you still have control of the money.
Great. Anything else anybody want to comment on? I think we covered a lot of great stuff.
We have.
Okay, well, I'll close it there. Just want to thank everybody. If you found that information useful, I encourage you to subscribe to our YouTube channel. There's all sorts of similar type videos, and to share and like this video. Thank you so much.
IBCanada Group, your independent authority for information on the infinite banking concept.